let's move on. And as the market embarks on the uptrend, we take stock of the investment mantra and the ideas to focus on in this market with none other than Value Quest, Ravi Dharamshi, in conversation with Nikunj Dalmia. Take a look.
It is always great to have Ravi Dharamshi back on the market, and especially when we are talking about turning points, especially when we're talking about mega trends and big themes. And today, it is the private equity or the private business investor day for ValueQuest and their clients. So Ravi, first, should we start with the public market or the private market? They both have different stories.
Let's start with public markets first.
Okay, public market. 10 days ago, everybody was trying to search where the bottom for this market is. Now everyone is saying that the bottom is in place. Let's now try and find the roof for the market. Where are we headed?
No, no, it's only in hindsight we will know where the bottom was. But the reasons that caused the correction, I think have been addressed. Whether it is government or whether it is RBI, whether it is in terms of fiscal, monetary or regulatory, everything has been addressed. And the main cause of concern obviously was valuations. Now valuations have corrected, come to long-term or below long-term average. So from that perspective, barring a major crisis breaking out anywhere in the world or domestically, I think most of the correction seems to be done. Can never rule out another 5% kind of a correction. But I would put my money on the fact that worst seems to be over for the moment.
The market fell because of two factors. Earnings were slowing down and valuations were expensive. Have valuations become attractive or they are still expensive?
So as I mentioned, if there were 2 standard deviation above the fair value, they are probably at fair value now. I won't say that the conditions are not such that we need to swing the pendulum all the way back to deep value. I don't think that's the case. We are more in a mid-cycle kind of a scenario where it is a little bit of growth slowdown, a little bit of margin compression. That's the issue. So this is not going to become a recession, or this is not going to become a balance sheet issue. So from that perspective, it remains a correction. And if it is a correction, then I think we can place our bets on the fact that more or less the correction is done.
Okay. So what happens from here? Which is that, are we in for a compounding market or are we in for a V-shaped rally?
I wish I knew that. I have no idea, no way of saying that. But I'm just happy about the fact that government is back to focusing on growth. They are back to, trying to ignite one more engine of growth besides government capex. There is now consumption trying to be revived. Also, I'm hoping for revival on the private sector capex and maybe broad basing of the real estate cycle. If those confluence come through, maybe not now, but maybe 12 to 18 months from now, then I think you will regret the fact that you did not deploy money at this point of time. Again, see, even during COVID times, we did not know how the recovery was going to be. At that point of time, we all thought that, okay, it's uncertain, but the odds are in your favor. I get the same feeling even right now. Future is uncertain, but the odds are in your favor. If you have more than 3 years outlook, time to be building portfolio.
Okay. They say market never reacts to the same thing twice. I think markets have already reacted to the tariff news at least half a dozen times. So even if tariffs are rolled out, do you think from a market standpoint, it is like old news and no news now?
Yeah, I think overall market should not be reacting going forward, but there might be some sector specific or company specific reaction that might still pan out. And I really feel that in the grand scheme of things, India is not a priority for US. So I fail to see how it can make any big impact on India.
Where have you shopped in this decline?
Wherever our convictions lie. No, so we continue to, so there are 3 buckets. One is the deep value bucket. Over there I feel the large private sector banks, some general insurance companies and some NBFCs and life insurance companies as well. These sectors fall under the deep value kind of opportunity. There are some sectors where there is continuing business momentum. So whether it is renewables, whether it is power transmission, these are continuing business momentum, and we continue to like that as well. And there are some new age sectors which are probably still not yet represented in the market, and which probably brings us to the private equity piece of it, is that aerospace, I think these are all new sectors being born in the market, and people yet don't know the kind of potential it holds. And that is what we will uncover some of it in our private equity investor day today.
Okay, some of the themes in the private equity investor day are aerospace, energy transmission. Now, these are big boy businesses which require a lot of capex. They are dominated by large groups, and while they are exciting businesses, they are not the typical pace where private equity investors they invest in.
No, so see, you are right. The larger piece, the large system integrators or the OEMs is the big boys game. But there is a big supply chain attached to that, where there are a lot of small players which can scale up quite dramatically. And energy transition is not one sector, right? I mean, there are so many sectors associated with energy transition. Nuclear, wind, solar, biofuels, power transmission, electrification, EVs, battery storage. So there are many sectors, and since these sectors are all still evolving, there will still be investment opportunities over here. So I would say that there are enough and more small and mid-sized companies which can scale up. And yes, they will need capital at this point of time, growth capital, and that's where we come in.
Okay. The history of Indian private equity investing is somewhat khatta meetha. There are great success stories, but there are a lot of companies which never make it to the big league. How are you, and since this is public money which you would be managing, how would you ensure that the private equity fund where you're investing in, the journey is going to be a smooth one?
See, nobody can ensure a smooth journey, but what I can say is that we have tried to address a few of those concerns. So number one concern is private equity tends to be an illiquid asset, right? Your money is locked in for 10, 12-year period. We have shortened that horizon. Our products are more 5, 7-year kinds. Number two, it tends to be, if you are at the the left hand of the spectrum, which is venture capital seed, then your odds of success are very low. So we have tried to find a sweet spot in both the things and tried to bridge the gap between venture capital investing and public markets by focusing on growth stage investing, companies that are likely to go public in a 2 to 3 years time frame, and companies that need growth capital before they are ready to do IPO. So that's the sweet spot for us, where we can improve the odds of winning as well as find businesses that can scale up, which are worthy of getting listed.
This is not for the first time we are talking private equity with you. One of the success stories for ValueQuest has been Vari. Then you've also invested in Wow Momos and a couple of other startups. Which have been the super hit names for you?
So again, disclaimer, since we manage money for the public markets as well. But yeah, Vari has been one of our big winners for us on the private equity side as well as on the listed market side. And the numbers are there for everybody to see. The kind of scale change that has happened in this company. This company used to be a 70 crore PAT company in FY24. And if I were to annualize the FY25 number, they'll end up with a 1700 crore profit in FY25. That's a fantastic scale up. I mean, that kind of scale up, where are you going to get in a manufacturing business in India? So we've been lucky, touch wood, that we hit it big with one of the first and the early investment in the private equity.
Okay. So the companies which you're showcasing, tell us a bit about them.
So we are focusing on 3 themes. Energy transition continues to be, and it will continue to be. Maybe next year also when we meet, we'll probably continue talking about energy transition. But there are 2 new sectors that we are talking about. One is aerospace and other is technology-driven businesses. Now, technology-driven businesses is a very, very wide term, but there are 2, 3 investments that we have done in the private equity space. One is a furniture rental company, other is a payment solution company. And on the aerospace side also, we have one company that is an aerospace tooling company, and other is going to be a aerospace piping solutions company for the large aircraft manufacturers. So these are all interesting opportunities, and I think as of today, there is not much knowledge, or markets don't know too much about the aerospace place. If I were to just give you a sense, and you can probably get a sense during the day, but the aerospace supply chain is shifting away from the Western developed world towards India, because post-COVID, this is a very highly skilled labor business. People have refused to come back to work, and this is one industry where they will not go to China. The IP protection is paramount over here. So India stands absolutely at the right place at the right time in terms of this opportunity to become plugged into the aerospace manufacturing supply chain.
So, energy transition is easy to understand. We can see it, we can feel it, we can smell it, which is that, migration, I'm breaking it for our viewers, solar to or hydrogen to solar, or, from fossil fuel to largely clean and green. It's easy to understand. So you buy a company which is in manufacturing, you buy a wire company, you buy a capacitor company, you buy a tower company. Aerospace is a slightly more complicated space because for a common man, you would say aerospace either is defense or it is Boeing or perhaps it is Airbus. Demystify it for us.
So first of all, energy transition 2 years back was as complex to understand. Today it has become easier to
We are
understand.
making it simple every day, Ravi. Sometimes media does a good job.
But in aerospace, if you actually go and check what Boeing CEO has made a statement today, they said that they are going to recruit more vendors from India over the coming next few years. Now that is a very telling statement. Now what has happened is in civil side of the aerospace, there are basically only two manufacturers, two OEMs, Boeing and Airbus. Boeing shot itself in the foot and Airbus failed to capitalize on it. Now they are running behind schedule in terms of delivery and they are constrained by capacity, and that on top of that their supply chains have gone disarray post COVID. So they are desperate to find vendors who can supply to them, and they really don't care about what margins you make as long as you supply the equipment to the specs that they want at the rate. If you can supply that reliably, they will not bother you about the pricing. That is the kind of pricing power these supply chain vendors are going to have. So again, it is a very simple thing to understand. The deliveries are running 3 years behind schedule. There is a backlog of as much as 20 years, the kind of order book that these OEMs have, and they are in need of supply chain partners, and all their European partners or the American partners, they don't have the ability to scale up from here.
Okay. Tech enablement. It's easiest thing to say, but very hard to scale up, right? We've seen great success stories, but we've seen a lot of failures here. How are you approaching this entire tech sort of, enablement?
So I think that's a fantastic question. Number one, I think we are not here to fund your land grab. That's not what we do. We invest in business models which are developed to the point where they don't burn cash. So we come in at a point in time where it's already, if not PAT profitable, EBITDA profitable and cash flow throwing. So all they need is some capital to scale up what they have perfected over a period of time, the model that they have perfected. So that is the differentiating fact about the kind of companies ValueQuest invest in, and as against probably what other business models are out there. See, we between the potential and the probability, we tend to focus on the probability. There should be a higher probability of making money than a higher potential of making money. Of course, who doesn't want the combination of higher potential and higher probability? But most often than not, if the potential is high, the probability is low. So you need to balance that between high potential and high probability.
Fantastic point. So let's wrap it up with one question on the valuations in general in the private equity space. There was this whole ringa roses which had started. You come in at a private equity stage, wait for the company to go public, wait for mutual funds to come in terms of anchor, and then you sell at the IPO pop. It had almost become a sequence, but that sequence has reversed. Have private equity valuations also corrected in sync with public markets?
So private equity obviously corrects with a lag, and it probably takes a longer time because the prices are not quoted. Honestly, though now there seems to be some sort of a market for every share, so there can be some reflection of that. But honestly speaking, it will take some time. It's a mental adjustment that the promoters have to make, the bankers have to make, the investors have to make in terms of what multiples that you are willing to pay. And some correction has already happened and some more will happen over a good period of time. But thing that comforts me the most is, even from the listed market perspective, is that there is no leverage over here. We are not talking about a severe downturn in the economic cycle. We are talking about high valuations getting corrected. And I think, as mentioned earlier, I think we are through with the most of the journey on the correction of valuation, and hopefully the same will get reflected in the private equity side. For us, we have a runway of next 3-4 years to invest. It's not like we have to invest today. it's a much different timeline that we operate in the private equity world. So yeah, I mean, I'm glad that this correction has happened. Some rationality will come back into the valuations.
Also nice to have you back on ET Now. Thank you for joining us.
Thank you so much.
Thank you very much.
All right, so that's the word coming in from Ravi Dharamshi.
If you like this video, then like, share and subscribe to ET Now.